joining us and bringing your jet lag for the next 20 minutes on the very important topic of Basel. So can I introduce to my left Ashraf, Global Head of Trade and Working Capital at ING, and Scott Stevenson, who possibly needs no introduction in terms of leading the Basel advocacy for the BAF group. And may I start with you, Scott? Could you give us a flavour, firstly, of where we are in the regulatory adoption of Basel across the major territories? So Canada now, US, UK, Europe, and a bit of APEC.
Okay, thanks very much. One of the things that I want to kind of start off in terms of the comment is that originally the Basel Committee introduced its first series of guidelines in around 2009, which would have been a succession to Basel II. And then in 2017, the Basel Committee came out with what they hoped would be a globally accepted framework for the application of capital. Since that point in time, what we've seen is countries going off in different directions. Some countries have kind of, let's start with Japan, which adopted the guidelines on a wholesale basis. Not too much discussion in terms of pushback against the regulators in Japan, but there are opportunities in terms of how those guidelines apply to the Japanese banks throughout Asia and its various branches. So there is still some opportunity for negotiation. In Australia, the guidelines have already been brought in and published. My understanding is that the Australian banks are comfortable with the guidelines that have been put out. There is some concern about the treatment of performance guarantees, in fact that they now have a higher weighting than previously, but still it's not as draconian as what the Basel framework laid out. Other countries in the European Union, there's been a lot of discussion, back and forth advocacy, of which the BAFTA has been part of. The original guidelines were really wholesale adaptation of what the Basel Committee put forward. After some deliberation, the European Parliament passed a series of guidelines that we understand are more favorable to banks. But those guidelines still have not been publicly, the final guidelines have not been publicly produced. We're expecting them sometime in October to be done. That really brings us to the UK, where the Prudential Regulatory Authority again put forward a request for proposal. Their framework is 100% adaptation of the Basel framework. And what was interesting is that BAF, together with the ICC UK and a number of other industry organizations, put forward a paper which is available on the BAF website. They kind of outlines why the approach that the Basel Committee had taken and PRA is now taking doesn't really give a true valuation of what the potential default and loss given default of trade products are. For example, it's showing in terms of, again, the performance guarantee, it's showing a 50% weighting versus the current weighting that's there. That type of increase basically would mean a 150% increase in the capital charge of that product. And one of the things we are consistently trying to do is to make regulators, for whom there's no real upside in terms of strict guidelines that they've issued, is trying to make the regulators aware of unintended consequences or possible knock-on effects. In all of these instances, the regulators are looking only at the banks. They're not really looking at who the end user of the product is, which is your corporate customer, your SME. And sure, there will be an increased capital charge, meaning the bank has to set aside capital, so the product will be more expensive. But that cost has to be passed on to the end user. And that, in these times of inflationary pressure, doesn't seem to make a lot of sense that you want to all of a sudden increase the product for international trade. We have not heard back from the Prudential Regulatory Authority of the UK. They actually went out and said that they don't want to hear what other jurisdictions are doing. They only want to talk about what they have. And so that's kind of a comment really regarding Brexit. And so we're kind of entering into an era where we can be exposed to regulatory arbitrage, but also in those countries whereby you can have a bank that has the option of being based in the UK or perhaps operating its international trade business out of Europe. You've got the opportunity for that business to be kind of moved wholesale out. Now that kind of brings us to the US, which at the end of July just came out with their guidelines. They are even more draconian than what the Basel Committee put forward. It's what we would call gold plating the regulation. Interestingly, when the Fed governors met about a month ago, there was a lot of discussion as to why these guidelines are even being brought in. As you're probably aware, there was some duress on the U.S. banking system, in particular with the Silicon Valley Bank. But it was publicly stated in this meeting amongst the board governors that the new regulations, which will now apply to banks of $100 billion or more in terms of assets, so that really puts it down into the smaller regional bank scope as well, is that those new regulations would not have saved the bank. It had nothing to do with the reason why the bank went under, and a lot of it had to do with just typical risk management that the bank was not enforcing. So in the U.S., what you have is a proposal whereby internal risk models will be taken away. A standardized approach must apply for everything. You have an instance whereby, for the first time, there is no standardized approach in terms of operational risk, and this is a great concern because, as Jamie Dimon said, and I'm going to quote him here because I thought this was a great quote. It kind of puts where we all are as bankers. And this specifically had to do with the fact that there will be now a capital charge placed against all operating risk of banks. And that has severe implications in terms of transaction banking. So Mr. Diamond said, are all revenues equally bad? Really? What person in the ivory tower thinks that this is a rational thing to do? So I think that kind of conveys our feeling as well as an association. We have to, of course, put that gently forward. It can't be done kind of willy-nilly. But I think it's important that we, BAFT as an association, have the ability to represent you and go directly to the regulators and probably have a more forceful response than you want to do as a bank. Nobody wants to be seen as openly challenging a regulator because you don't know what the unintended results of that will be. But so we've got different jurisdictions with different applications of the Basel, all of which mean in one way or another more capital increase. And what the thing that we're trying to do in our advocacy is to ensure that the regulators are more aware of the knock-on effect. In Europe, we were able to lobby. In the UK, we will be able to lobby in terms of Parliament. In the United States, there is no such ability. In the United States, once the Fed puts out its guideline, decides what it's going to be, there's no further discussion. So it's really important that we receive an association your inputs and your data, which will be scrubbed and then minimized in terms of how we use it, of your own performance portfolio of what's being done. The last thing that I do want to comment on is that it has to do with counterparty risk, as it's being applied in the US, but also in the UK. And it basically works to negate the power of credit insurance or credit reinsurers. And if you're using those to enhance your portfolio, enhance securitization, it means an increased capital charge is going to apply to those products as well. So that there's a whole range of things that are happening, none of which are seen as being positive in terms of our performance as financial institutions.
Well, Scott, thank you for that very comprehensive overview. I don't think you're going to get to the lunch without a bunch of questions. But as you mentioned, Ashraf, I'm going to turn to you, as you mentioned about the success of the EU lobby in having some of the applications withdrawn. Could you give the audience a flavour non-competitive information, of course, around how that has impacted your trade finance strategy. And then we can move on to talk a little bit about pricing to our clients and the impact for clients.
Yeah, that's a good question. To continue on what Scott just mentioned, what we all want as an industry, obviously, is to have a fair treatment, not necessarily get, let's say, the best possible outcome for our balance sheet, for our P&L, or risk-weighted assets. And I think the lobby that was also coordinated by the ICC led at least to an improvement of the credit conversion factors on the guarantees and on the SBLCs when it comes to the 50% going down to the 20%. I also understood that it's not yet formalized that also the non-trade related part will also be getting the 20%. But our internal models, that's what I find okay, will be lost in that sense. It comes down to data. We also, in this lobby, we show data that shows a certain performance. And we now have our proper LGD models, our own EAD models, which have historical data sets behind them that can show the actual performance of certain products, especially if you look at the coverage that we have in certain products with insurance, etc. And that benefit will be lost. So yes, we need these standards internationally. We see different regulators, although 28 of them came to an agreement in 2008 and the aftermath of the financial crisis. It did bring us stability and better resilience to future shocks. But I think more trust in the data we deliver, understanding what business we do, does help to get these CCFs and also the maturity floor, how going from 2.5 years to the actual floor, all these elements together is what in the end is built in our pricing models. So if we need to make a certain return on our equity, and we are indeed getting these stringent CCFs and other regulations, it will make our products unsustainable. And that's also why I'm happy, to be honest, that also corporates figure this out and also join the lobby. So from a Europe perspective, and as Carlos said, it's in a couple of weeks we will expect the amended text. I do think that we will be in a position to accept what will be brought forward.
Certainly, just to say, as a representative of Japanese bank, isn't also that the Japanese banks are now working together in terms of advocacy, in terms of all of the banks, the 3 mega banks of Japan, coming together to say surely it's not the industrial policy to make Japanese banks and their customers disadvantaged in terms of pricing. But I wanted to ask you a little bit about how you see it changing in your actual product strategy or your trade finance strategy. I can say from an MUFG perspective, we certainly see, as we roll out SA across the territory, in 46 countries, and many of those in APAC, none of which are motivated at all to deploy a standardized approach. So we go and roll it out where the regulators are more keen than we do, like EMEA and US and Canada as well. But certainly we're starting to see trends, right? Obviously we're all pressured for client returns. You know, many of us in this room, whether we like it or not, are trade finance businesses might be 60% documentary trade, traditional trade, and 40% open account type trade. You know, one is, high volume, full of risk, low margin, and needs the digitization and collaboration of networks. The other part, more complex, more sticky, and certainly somewhere where all the banks want to pivot and support deep tier financing as well. So we certainly see know your bank's capital structure and branch subsidiary structure. We start to see a lot of arbitrage between the correspondent banking community around first and second confirming strategies, to take advantage of those who rolled out SA and those who didn't. So that's one aspect of the strategy. The product pivot between traditional trade and more structured receivables is something else that we see, and fierce competition for cross-sell, especially banks that don't have a native dollar pool, which is what funds our global trade. How do you see it, Ashraf, from ING?
I think there are a number of elements in the strategy that change due to this. So obviously we have to compete with other parties within the bank and themselves. So we look at the returns set with the lending board and then the financial market value. And then what you see is a shift towards a, let's say, relationship-driven approach. So where we have our, let's say, platinum customers, we do offer them a full package, knowing that certain products will remunerate less, but the total package, the sandy check as we call them, will still be above the hurdle we have set for ourselves, ROE-wise. But on the other hand, where you do not have that strong connection and you're not an anchor product as such for this platinum relationship, you see that shift towards the, let's say, more covered, more securitized receivables portfolios, the TRPBs, or even towards a more supply chain finance approach with a card solution instead of the traditional one, and you stay away from the non-external rated companies, basically, because that's also punishing. So you do see a shift there. In our case, even last year already, we saw that shift happen towards open account, as you just mentioned, significantly. But we are considering our position in the markets also, and for our key customers, we continue to offer these products.
Super. Could you talk a little bit about, much of the discussions today touched on technology and data strategy. You know, as all of us in banks have to focus on regulatory change and compliance first, how are you seeing the scope for investment in trade finance and digitization, global collaboration, and so much of it is tied up in reg change, data cleansing, compliance, new firm systems to do everything faster and instantly globally? How do you see it?
Yeah, I think I speak on behalf of everyone here. The budgets are not that large to cover everything, obviously, so you will have to make choices. And data is, well, if I get back to what's called 2008, they started the discussion. The implementation was 2017. Now it's the same thing. So in the end of this year, we will get the implementation 1st of Jan 25, but that's only the start. There will be more to come in the 5 years after that. So we need to focus on that. You have to adjust your models, remodel certain models, change everything in your systems. And in the end, you will not be able to really support the digitalization from a budget perspective because there's simply not much space left to do that. And that's, I think, the key. So if we could collaborate more in the industry to get to a central registry where at least the data is available also for these bodies to make a proper judgment. Exactly, evidence-based. That will be very helpful, I think, going forward. But also, it means we will have to collaborate more between ourselves, also on the digitalizing front, instead of each for him and himself. Okay.
Couldn't agree more. So where do you think the next level of advocacy will come from?
Well, I made mention of the fact that the major concern is really on the knock-on effects to the clients. And I think it's very important for us to be able to call upon various corporate bodies, end users, manufacturing associations, supply chain finance associations, chambers of commerce, local chapters of ICC, but also, say, in the United States, the U.S. Chamber of Commerce, to pull in the end users to be able to give a concerted response in terms of what the effect of these new regulations will